welcome back, traders and investors. We have Greg Michalowski on the line. He's president of GregMikeFX.com and author of Attacking Currency Trends. He has 28 years of experience as a trader and a financial analyst. He's worked for Citibank, Credit Suisse, First Boston, and 13 years with FXDD as a retail forex broker. He has tutored thousands of retail traders around the globe, and he's written a book. How you doing today, Greg?
I'm doing well, Joel. Thank you for having me.
No, thanks for coming on. So tell us a little bit about your book.
Oh, attacking currency trends. I tell you, it came at the right time in my career. I've been involved in the financial markets, as you said, for a number of years, and spent a lot of time the last 13 years in the retail foreign exchange market, and I've been able to see what retail traders do right and wrong. So my book is geared for mainly for retail market, but it can cross over to other traders as well. And it takes traders from, I think one of the unique things about the book is it takes traders from a mission statement. What is your mission as a trader? To make the most amount of money with the least amount of risk. That's my mission. You could use that in life. You can use it in trading. You can use it in anything in life. But you're trying to make the most amount of money with the least amount of risk. And then you go on to a game plan, and you go on to rules. And finally, you get to the point where you get to the tools that you should use that support the mission statement and game plan and rules and tools. Everything comes together in a nice, clean package. I'm about consistency. I'm about simplicity, and I'm about keeping tools very simple and the same tools over and over again. And that's what the book tells you. I'm happy to say it's one of the highest ranked books on Amazon. Lots of 5 stars. I think I looked at it. It was 45 comments in there, and 40 of them were 5 stars. I'm very proud of that.
Oh, congratulations on that, Greg. What specific tools do you use when you're approaching your currency trades?
All right. When you talk about attacking currency trends, I know the market isn't trending per se now on a longer-term basis, but there are a lot of little trends in the foreign exchange market and in markets in general. And I use 3 tools. I use moving averages. They define a trend. I use 100 and 200 bar moving average. I use trend lines. Trend lines define a trend. They also tell you when trends are over. So do moving averages, by the way. And then I use Fibonacci retracements, because Fibonacci retracements get those corrections. You're talking about the merger today and how the market was pulling back. I like to watch those pullbacks because those are where you get on the trend if you miss the trend. And so those 3 tools really help traders and really define the risk and define the trend for traders. So those are my 3 main tools that I use. I also look at different time periods in a way just to find what I call borderline levels where different sorts of traders line up. I want to know what the shorter-term trader's looking at and what levels are lining up for him. So I'll look at the 5-minute chart. I want to look what an intermediate trader's looking at. What levels are important for him? Where's the 100-hour moving average, a 200-hour moving average, a trend line? And if the intermediate-term trader's lining up with the short-term trader, that's the place that you want to get in on a trade. And so that's what I focus on in my tools and in the charts that I use.
And a couple questions here. Number one, I know some of these currency brokers. They'll let you in for like $500 or a very small amount. Is it really realistic? I know you can trade very small. Is it realistic to think that you can start an account with that little of amount of money and be able to go through the learning curve and be a successful trader? Following up on that, what do you feel is an appropriate amount of money to start trading with? And then finally, what's the biggest mistake that new currency traders make?
All right. As far as the account size goes, if it's 500, 5,000, or 500,000, the focus should be on the risk. The focus should be on the risk. if you're trading a $500 account because you're a student, and you that's all you have. Not a student, someone who's just got out of college, and you just want to learn a little bit more about trading, foreign exchange, and stuff. You have to. What's important is understanding that you can't just treat it as bet red or bet black, and I hope I make 1,000. You have to treat it as I want to risk 1 to 2% or 3% at the max on any single trade, and treat it as if you're really managing that money. Now, what is a realistic amount for a trader to get involved in the market? Start with 5, start with 10, but don't have expectations that you're going to double that. It's a marathon. The name of the game is to stay in the game, and that's what you have to do in your trading. Now, I think the next question, or one of the questions that you asked, was what is the biggest mistake that traders do out there in the retail? And they focus too much on the reward, and that sounds weird to say, but I hear so many traders say that I'm going short the euro, and I think it's going to 128, and that's just unrealistic because there's 133 to get through, and there's 132.26 to get through, and there's other levels that you need to get through before you get to there. And the main thing, though, is to focus on risk. Risk is the most important thing that any trader can focus on. I use 3 things. You want to define risk, you want to limit risk, and then you want to accept your risk. Define risk and limit risk tells you what you're going to potentially lose. And if you don't lose it, you have a reward. How do you define risk and limit risk? Using those tools that I talked about. Those are your borderline levels. Those are the levels that tell you get out because the market isn't doing what you thought it should do. And when I talk about the word market, the market is in control. You're not in control as a retail trader. You cannot move the market. The market moves itself. So if you can't move the market, you're at the mercy of the market. And so you have to have that humility and that understanding that what I have to understand is where the market perceives risk. And if you concentrate on risk, I think you'll be okay as a trader. Most traders don't do that. I want to move them that way.
Greg, I couldn't agree with you more on the risk management thing. I've been a prop trader for 15 years. Joel's been a trader for 25 years here, and we've stayed in the game by having good risk management skills. Obviously, traders, approach that differently. How do you approach your risk management? Do you set stops? Do you know your levels before you enter the trade of where you're going to get out? I always when I enter a trade, I always have an out. I always know where I'm going to exit the trade if it doesn't work my way. Do you approach it the same way?
Yes. I believe in getting in a trade with a reason or reasons. So I am not going to get in the trade unless the market's bouncing against a technical level defined by my tools, or hopefully multiple technical levels defined by my tools and charts. So those levels are where the market should move. But by that I mean the market should move away from those levels. If you know that the market's going to move away from a level, whether it be higher or lower, whether you go short or you go long, it doesn't matter. All that you know is that the market is going to move away from that level. And so that level becomes the reason to get in the trade, and it also becomes the reason to get out of the trade if it doesn't do what you think it should do. And so, there are people who say, well, you can't pick a top or you can't pick a bottom. I look at charts all the time and see the market banging against the 200-hour moving average and moving away from it. And that's where I want to trade. And if I'm wrong, I know quickly, and I lose a little. If I'm right, I can make more than a little, I like to say. I'm not going to say that you're going to make it, 10 times what you risk. I'm just going to say you're going to make more than a little because you're risking a little. And so it makes it easier for you to make more than a little. And it's as simple as that. So my stop is right around where I get in. And that is a comfort to me. It also reduces my fear, it reduces my anxiety, because I know either I'm going to be right or wrong. Remember, I can't move the market. The market's going to move the market. And all I have to know is where the market is going to move away from. And if I use tools like trend lines and Fibonacci retracements and moving averages, I've found that those are levels that traders move away from. They're like, kryptonite. They don't want to stay near those levels. And so that's what I focus on. And so my risk tends to be very small. But, as a percentage basis, 1%, 2%, 3% at the most. There are times when, you want to risk a little bit more because it went to a key level, and you say, well, that's my line in the sand. I'm going to keep this on a little bit longer, risk a little bit more, and that's when I use it, 2 or 3% or something like that on a trade.
And what are your time frames for trades? I mean, to me, it sounds like you're pretty you're pretty careful and like picking your spots. It doesn't seem like you're in there trading a lot every day. I mean, how often do you pull the trigger, and then what's your time horizon?
That's a good question because my book is about attacking currency trends, and I believe that if you get in a trade for a reason, you should get out of a trade for a reason. And the trade doesn't just start when you put it on. It continues on, and you're continually surveying the market. Are we below the moving averages? Yes. Did we hit a key? You have to go. Did we hit a key target and bounce off of that? Did we go through that target? Okay, we're through the target. Now manage the trade down. So trades can last, intraday, or they can last, for days. If you get a trending market, you get good trade locations, and they can last, a longer time frame. So I'm not necessarily about day trading, and not about. I'm about letting the market tell you when to get out. When the market tell you to get out, and you follow the market. You target levels that it has to get through. Those levels are defined by your tool, so everything's consistent. Once you get through the 100, you got to get through the 200. Once you get through the 200, you got to get to the 38.2. Once you get to the 38.2, you got to get to the 50%. It's like driving down the road. You can't get to exit 78 without going through exit 72. You have to get through those target levels and those exits, those points where you can get off the road. And if you can't get through those levels, then maybe you think about getting out at that point, looking for the correction, getting back in on that correction. So it's just there's no right answer to that, but it's just let the market tell you what to do.
Now that's a good point because a lot of times with my trading, I don't necessarily look like, okay, it's going to hit this level and I'm going to short it on a pullback. The way I'll approach it is, well, if it gets through this level, I have my expectation is it's going to move up to the next level. So I'm letting,
Sure.
I'm not trying to fade the market, but I'm trying to say, okay, I'm not going to buy it here. But if it, if it shows the strength, then to continue, just getting away from all the technicalities here of trading. I mean, obviously, if you're trading, foreign currency pairs and whatnot, the actions of the Fed and the numbers that are released are, have a huge impact on the currency exchange rates. Do you tend to sit out the events like the unemployment number, or are you in them and letting it hit a target or stop you out on something?
Right.
How do you approach all this economic data that we get?
Well, I try to rank the economic data. Remember, I'm about risk, okay? And risk doesn't stay the same all the time, does it? So there are different times when there's more risk and there's less risk. And if it's going to be a bet red or bet black like an unemployment report, if I'm going to keep a trade through that I better have some profit that I can stand to lose, rather than losses that I stand to add on to if the release doesn't go my way. So I'm not about betting red or black on some non-farm payroll where there's 300 million people in the United States, and we're gonna if it's off by 50,000. It's going to cause me to, lose, I can't pay the mortgage this month or something like that. I'm not about that type of, betting, if you will. And those are bets. I'm about defining risk and limiting risk and getting in after. We have the unemployment report this week. Getting in after. So what I'll do is I'll take a look at the chart and I'll look at targets above, targets below. Where do we stand? Where's the key borderline level now? Where's the 100 and 200? Where's the trend line? And I'll map out the road I'm going to take. I'm going to GPS where I have to go. And if it's bullish, I'm going to see if it gets above, and it's bullish for the dollar. I'm going to see where the dollar goes, and then look for the correction against a level, an exit that we just went through, or a level that we just went through. Come back, lean against that level, and get on the trend that way. If it's bearish, I'll do the opposite. And so you may miss the first, 20, 30 pips of the trade, but the goal is to get in on that trend and ride the trend when the risk is down, when the event risk is down. There's no need to go into the market when everything is on fire as far as risk goes. You have market risk, you have event risk, you have liquidity risk. All those are at their extremes. Why get in the market then? Get in the market when the event risk is gone, when the liquidity risk is gone, and you're just trading the market risk. That's when I try to get in.
Greg, one last question before we let you go. Coming from the chat, we got Rob Hood asking, is there a way, do you recommend a way to better understand Fibonacci retracements? Do you have like a book that Rob could look to, or?
Yeah. Well, that's a great question. My book talks about Fibonacci retracements, how I use them in particular, and also with my new adventure with Greg Mike FX, I'm going to be giving seminars and webinars, if you will, a series of lessons that will go through the Greg Mike FX way, if you will, so look for that. If you want information on that, just go to our website, Greg Mike FX, and put in your email address. But for Fibonacci retracements, just in general here for the audience here, because I'm not about a commercial here, but I can go on and spend a couple hours talking about Fibonacci retracements. The way that I look at them, Fibonacci retracements in a market, is I'm looking for a trend-like move. Okay, now what defines a trend-like move? Fast, directional, and the range tends to be a little larger than what we've seen. Now, you can apply that to a 5-minute chart, you can apply it to an hourly chart, you can apply it to a daily chart, but fast, directional tends to be a larger trading range than what we've seen. That defines a trend-like move. And then I'll apply a Fibonacci to that trend-like move. It could be, it doesn't necessarily have to start at the bottom, but what I'm looking for is a retracement of 38.2 to 50%. I call that the correction zone. And if you think about it, when the market's going up, it's trending to the upside in a fast and directional type of move. When the market starts to correct, and you're always going to get profit takers, you're always going to get those corrections. If you see the market come down to 38.2 and find support there, you're waiting for it. You're waiting for that 38.2. You buy against the 38.2, put your stop against the 50% or below the 50%. And the idea is that the buyers were in control on the way to the upside. When that price or when that instrument comes on sale, 38.2% off, you expect the buyers to return and to keep control. And those sellers get nervous and they start to cover as well if it doesn't start to go below that 38.2, below that 50%. So that's where I'm trying to get in what I call the correction zone, 38.2, 50% of a trend-like move. And you'll find that a lot of times the market will come down into that area, and I'll show it on my website at Greg Mike FX and blogs and all that other stuff. That is where you want to be involved in. If you miss the first trend, get in on the correction near that level. And if the buyers are going to get into control, they're going to hold it there. If the sellers start taking back control, they're going to push it through. So your risk is limited, your risk is defined, and you just let it go. See what happens.
Okay.